Hey everybody, welcome back to Drawbridge Finance. My name is Levi Woods and this is an opinion channel about money. Today I want to talk about some basic terminology, the long position and the short position. Before we get started today, I want to tell you about dinner last night. Green and I took some pizza and beer and we went to a friend's place, and it's been quite a while since we hung out with these friends. And the gentleman there, he is a full-time day trader, so it's pretty interesting for me to get together with him because I day trade as well. I'm an options trader, and I very rarely buy and sell stock directly. I always buy and sell options, and there is a difference between those two. But we have a lot of correlation between the types of companies that we're looking at and what we're doing. Now, he does it full time, and myself, I still work. I'm going to be working for the next year and a half or so until I start to really dwindle down. And in fact, you guys have probably noticed that I've been releasing more videos, and that's partially because I've been working a little bit less for these last couple months. I've been taking a bit of time off to try to grow my YouTube channels, and of course, I'm starting to realize that it's difficult for me to grow these channels without your help. Really, the information that I provide on the channel is completely free to you. There's some ads that play, and those small ads give me a little bit of income. The income's pretty itty bitty. But in order for my channel to flourish, I need to see substantial growth. So when you guys are watching these videos, if you're finding them helpful, and I hope that you do, then I would really appreciate it if you could leave a comment down below, if you could give the video a thumbs up, or if you really like them, if you could share it on social media. I mean, that would help the channel grow a little bit, because ultimately the goal of my channel is to help people build their wealth. And in order for me to do that, I have to be able to make enough videos and spend enough time with people so that they can actually learn some of the things that I've done. It's not something that I learned overnight. I have a very specific strategy, especially with options. And I am more than willing to show anybody that wants to know how I do it, because that's it. I love it. I love doing it, and I love talking about it, and I would love to help people make more money. So in order for me to do that, I have to spend the time to generate these videos, and that requires a bit of help from you. So if you guys could help me, that would be amazing. I would love it. I would appreciate it. Everybody else would as well. So on that note, we were out with some friends. He's a full-time trader. I'm a part-time trader, and we started to talk about what he was trading, and he said he was waiting for cryptocurrencies to return to value. And I didn't even know what to say. I was like, what the? He immediately kind of diverted the question and started asking me about the YouTube channel, and said, like, it's so great that you're like helping people and you're investing at the same time. And I was just sitting there thinking, like, what? Like, he really, like, did he go all in on cryptocurrency? Is that what happened? And it turns out he did. He took his whole portfolio and he's invested in cryptocurrency mining companies, and they are floundering. It's like he's not diversified, and he bought product that the only way he can make money is to sell it for a higher value, and right now it's at a lower value. So it's not paying a dividend. He's not making any money. He's literally just sitting around waiting for it to recover. And I didn't even know what to say. The conversation pretty much ended there. So today I want to talk about how we can make money on the stock market, because there's two primary ways of making money. The first one is to very passively invest, where we buy a dividend paying stock and then we hold it for a long time and we collect the dividends on a monthly or quarterly basis. This is an income generating strategy. We can do what we want with the dividend income, but basically we purchase stocks and then those stocks pay us. So we buy something that pays us. That's the first way to make money. That is following rule number 3. Invest primarily in dividend paying equities. The second way to make money is to sell something for more than we paid for it. So in theory, this sounds great. My friend bought some cryptocurrency mining company stocks, and then he's going to hold them for some period of time. And when they're worth more, at an acceptable level of profit, he will sell them. So his profit will be the difference between what he paid down here and what he sold them for up here. The profit is the difference between the two prices. Now, almost every business in the world functions this way. They buy a product of some sort, a service or a product at a price, and then they sell it to someone else and they collect the profit. It's like a basic business model. We buy low and we sell high. When we think of it in terms of investing, this is an active trading strategy. We have to actively purchase and then actively sell the product. If we purchase but don't sell, then we'll never get the profit. So if a stock is, at $10 and goes like up and up and up and up, and we don't sell, and then it goes down to $10, and you've held it for 20 years, and it was $10 20 years ago and $10 today, you've made absolutely nothing. Buying and selling of stock requires active trading. We have to know when to buy and when to sell. Both of these strategies require us to hold the stocks for a certain period of time. With the dividend strategy, you purchase the stock, you're expecting it to either be flat or to go up a little bit, and you're going to collect the dividend. So you're going to hold it for a long period of time. You have a long position on that stock. In the growth scenario, where we buy low and then we sell high, you also have a long position. When you make the purchase, you own the shares, there is a positive number of shares in your account. That is a long position when the number of shares are positive in your account. Taking a long position literally just means that you are buying. So we can take that position on a multitude of different types of investments. We could take a long position on a house, which means we purchase the house and then we own it. We're going to sell it later. We could take a long position or make purchases of shares or bonds or currencies. And we can also purchase things like oil or gas. So on the flip side of long, we have this term going short or taking a short position. Technically, going short just means you're selling that position. So having a long position means we have a positive balance in our account of whatever it is that we're investing in. On the flip side to that is going short. What this means is that we have a negative balance of something, which is a little bit hard. People don't quite understand that. They're like, well, how can you have a negative balance of something? It's really actually quite simple because we do it all the time. Say we have a plumbing store. Now, they buy product from their manufacturer and they put it on their shelves so that it is stocked and ready for sale. They have taken a long position on those items. They own those items. Now, a customer comes into the store, into the plumbing store, they look at the item, decide they want to make the purchase, they come up to the till, and they purchase that item. The plumbing store has made profit by buying at a lower cost and then selling later at a later date for more money. So they have taken a long position and then paid off by selling for a profit later. Now, taking a short position is very, very similar, except the store is going to sell first and then buy it later. You wonder how they can do that. But say this customer comes in, they're looking for a specific product, and the plumbing store, doesn't actually have that product available. The plumbing store looks it up in the catalog, the product's available, and they say to the customer, it's no problem, if you'd like to special order this item, you have to pay for it first. The customer has no problem with this. They fork over their money, the item comes in a couple of days, and the store has benefited from a short sale. They had created a negative inventory for a short period of time. They had purchased the item for a lower price and then sold it to the customer at a higher price, except the sale actually happened before they made the purchase. Now, a lot of businesses would actually function quite well if they could do this, because you would never have like old stock laying around. If every single customer came in, had no problem waiting for that item to come in, then you could just drop ship every single thing in your store. You sell first and then buy later. Now, there's a major disadvantage to this. If the plumbing store said to the customer, oh, I can get that part, but it's going to take a year, the customer is not going to make that order. They need this part. They're going to go to another plumbing store that either has it or is able to order it in a shorter period of time. Now, this is one of the major components of selling short. There's a time factor. Because of that time factor, it allows us to make investment decisions when a stock might be actually going down. Because time is a factor in this scenario, it has a value. And that is where we start to utilize short selling, because we utilize the time value associated with the short sell. For example, if you thought that a stock was going down, you would be able to sell the stock at a higher level and then at a later date buy it when it was worth less. So having a short selling strategy allows us to make money when a stock is going down. Unfortunately, it has to happen in this compressed amount of time. A lot of our brokers won't actually lend us that money or allow us to have short stock for an unlimited amount of time. We might have to turn that around in a couple of days. This is where option strategies start to come into play. Because an option strategy allows us to play either the upside or the downside on any position, what it allows us to do is start playing that time factor. So we can actually make money on an options play if the stock goes down, stays the same, or goes up. And there's a lot of different variables available, so you can be really specific about exactly what you think the stock might do. And that's where we start to be able to make money with options. I feel personally, as a trader and as somebody that's quite adverse to risk, that by playing options, it allows me a lot of flexibility, and I'm not relying on either buying a stock at a low value and letting it increase in value over time and then selling it for more, or selling it first at a high value and then decreasing in value quickly and then buying it for less, but instead playing a range. If I have a stock here, I can kind of set a range and say, okay, well, what if the stock stays below this mark or above this mark price-wise, and time goes by, how can I make money? And it's surprisingly easy to generate a regular amount of income by playing positions that are relatively neutral, which means we don't have to have the stock go up a lot or down a lot, but we can actually just let them kind of float along. So the key takeaways from today is that if we hold a long position, we're the buyer of the position. If we're taking a short position, we're the seller, or we're short. We have a negative inventory of whatever that product is. I hope you guys are enjoying my channel. I hope you've subscribed. Remember to leave a like down below and leave your comments, because I'm going to be doing a whole series of options trading videos, and I think that you guys are going to learn a lot. Let's get rich together. See you soon.